Hey guys, welcome to Lazy's Finance. In the last video, we learned that the activity of buying and selling of the stock market is called as investing or trading. But did you know investing and trading are used to refer to different activities of buying and selling in the stock market? In this video, we are going to look at what is investing. As this is a big topic, we'll be covering it in 3 videos that will be uploaded one after the other in the next few days. With that said, what is investing? Investing is buying financial assets and holding them for a long time. The minimum period is 3 to 5 years, but can be as long as you wish to hold the asset. Now think about this. When we invest in something for such a long time, don't we expect to get stable returns? Think of assets or stocks of companies that would fit this criteria. Did you think of assets that give stable returns such as fixed deposits or bonds? Or maybe buy metal that appreciate over time such as gold and silver? Or maybe stocks of big companies which earn consistent profits such as Apple, Samsung, Google, Reliance, Tata or any other MNCs? Well, the companies and assets I named are popular for the same reason. And according to an article I read online, there are 1.2 crore active investors in the Indian stock market. They are asked the same question, wouldn't they name a lot of the same companies and assets? The answer is obvious. We also know that the demand increases the price of the asset or stock. So shouldn't we know if we are investing at the right price to earn a decent profit? Let me illustrate this with an example. When we are looking to purchase a smartphone or a laptop, we want to make sure that we are getting value for our money. So we would compare different options in a similar price range and consider factors such as brand, model, specification, customer reviews and ratings. You would also consider its features, performance, durability and customer support of each option. After considering all these factors, we would choose the option that has the most features, performance, durability and customer support for the price we are willing to pay. In simple terms, you would choose the smartphone that provides the most benefits and advantages for the price you are willing to pay, rather than the smartphone that doesn't give you the best value for your money. Additionally, we also wait to see if the product goes on sale and try to club other offers to further reduce the price and make a good purchase. Just as we compare and research different options when purchasing a smartphone to ensure that we are getting the best value for our money, shouldn't the same principles be applied while investing in financial assets? And this method of investing is called as value investing. Value investing was popularized by Benjamin Graham and David Dodd in their 1934 book named Security Analysis. They argued that by purchasing stocks that were priced at a significant discount to their intrinsic value, investors could achieve higher returns over time. To learn more about the psychology of investing, it is recommended to read The Intelligent Investor by Benjamin Graham. This book is really insightful in the process of investing and becoming a profitable investor. With that said, let's get on with the video. What is intrinsic value? Intrinsic value is a way to measure the underlying value of the asset. It takes into account factors such as earning, dividends, and assets to determine the true value of the asset. Investors use intrinsic value to compare the current market price of an asset to its intrinsic value to determine if it is a good investment opportunity. Intrinsic value is very difficult to determine as it is based on assumptions and speculations about the future. For example, two investors who work in the same office right next to each other may have different views of if the asset or the stock is overvalued or undervalued. To illustrate this point, I'll use IRCTC as an example. If you remember, in the last video I had used IRCTC to show how money is made from the stock market. I'll leave a link in the description down below. Please watch that video to understand this point better. My friend had invested in IRCTC stock in November of 2019. Before investing, he looked at the financial statement and determined that it was worth investing in. And also at that time, many people were talking about how the stock prices rose in 1 month and he decided to buy. I had another friend tell him that it was not worth investing at the current price, but still he invested anyway. He bought 10 shares at a price of 872 rupees and planned to hold it for 3 years. The first year was great. He made a profit of 4,180 rupees, which is a 47% increase. And within the next 6 months, he made a profit of 13,120 rupees, which is almost a 150% increase. But at this point, something went wrong. By the November of that year, the price dropped to 820 rupees, netting him a loss of 5%. And in the last year of his investment, the price dropped even further to 755 rupees and he lost 13.4%. Do you know what the current price is? As of recording of this video, the current price is 641 rupees. My friend could have pulled out his investment in the first year and half and walked out with a profit. Or if he had done a bit more research and listened to my other friend instead of following the herd, he would have not made a loss. But how did my other friend know not to invest in IRCTC? Well, he determined this by following the principles of value investing of a world-renowned investor. Do you know who this world-renowned investor is? Let me give you a clue. He's also one of the most recognized stock market investors around the world. For those who answered Warren Buffett, you are right. Warren Buffett is an American investor and philanthropist. He is widely considered to be one of the most successful investors in the world and has a net worth of over $100 billion. He is mainly known for his value investing philosophy, which involves finding undervalued companies which have strong fundamentals and holding on to them for a long term. He has consistently outperformed the stock market over the course of his career and is considered by many to be a role model for investors. Though how he researches and selects stocks is a secret, but the principles he used during this process is public knowledge. What are these principles and how to use it will be in the next video. I hope you guys liked how I presented this video. If you did, leave a like on this video, share the video with your friends and subscribe to the channel to see further videos like this. With that said, see you in the next video.